Good evening and welcome to the Equity Axis Earnings Review. I am Desmond Tafuma, but you can call me Dollars Des. On the show, we dive deep into company financials and operations to make sure you're furnished with relevant market information to help you make wise investment decisions or to simply serve your curiosity. We also put top executives under the spotlight to answer some of your most burning questions, as well as chat with the most revered analysts on the market to help us make sense of some issues. In the books tonight is First Capital Bank, which was formerly Barclays Bank of Zimbabwe. After more than 100 years operating under its parent company, Barclays sold its majority stake in Barclays Bank of Zimbabwe to FCB Capital Holdings, a Mauritius-based Malawi Stock Exchange-listed holding company that is backing operations in Botswana, Malawi, Mozambique, and Zambia. First Capital is an iconic institution in the local banking sector, operating across the full spectrum of retail and business banking and corporate and investment banking with 88 branches nationwide. In addition to mainstream financial products, First Capital Bank offers motor, home, travel, and business and personal insurance services. We now take you to an earlier conversation with the bank's managing director, Karen McSherry, and bank CFO, Titus Mukuku. Enjoy the conversation. Thank you once again for joining us on the earnings review, Mr. McSherry and Mr. Mukuku. We're not going to waste any more time. We're going to get straight into it. In your report for the year ended 31 December 2020, you lamented the adverse effects that COVID-19 had on business. Fast forward to this year, the virus is still ongoing, but the difference, however, is that we have launched a vaccination campaign as a nation. How has that raised business prospects, and are you, as a company, conducting any in-house vaccination campaign?
Sure, thank you for that. Yes, well, COVID-19 hit us, as you know, last year, and it has continued into this year with the various waves. So, like all companies, we take our responsibilities very seriously. So we have strict COVID protocols in place, both for our branch operation, but also in our office environment. We're also conducting a vaccination program with a partnership with our health providers. And I'm pleased to say out of the 500 staff, we have roughly 300 staff who have had at least one vaccination. And we have another 100 who have had at least two. So we have about 130 to go in terms of people who are yet to get vaccinated. But we're very much encouraging our staff to get vaccinated so that they can be safe and their families are safe. We're doing it not just for our staff, by the way, we're also doing it for our staff and their families as well.
Thank you so much. That's impressive. Maybe we can throw this one to Mr. Mukuku. Zimbabwe is emerging from a scarcity of forex, and in the half year to 30 June, your foreign currency denominated loans swelled to 80 million from only 1 million last year. What has been the driver, and how do you project the foreign currency dynamics to play out in the economy in general from henceforth?
Okay, thank you. So I think in terms of lending in foreign currency, the major driver, we are seeing demand coming from the corporates, and it's the corporates, largely the foreign currency generators. We are the exporters and to some extent domestic earners, and their demand is largely around working capital, and to some extent there's also the capacity growth, which talks into capex. So the demand for us to grow the loans from 1 million to 18, it's largely because the corporates, I think to some extent, they are seeing some level of confidence in terms of how the economy is stabilizing. So they are now growing their volumes, capacity, they're growing their capacity. In terms of the foreign currency dynamics into the future, I think for the customers who are exporters, would think that they will continue enhancing their capacity, and they'll be able to export more once the COVID pandemic maybe starts to cease. The domestic generators, there have been some confidence which has been brought in by the central bank regulations, where the use of the multi-currency was allowed. So I think that has brought in growth in the domestic foreign currency market, where the domestic foreign currency deposits now they are around 1.6 billion total market.
So on that same note, the RBZ governor, Dr. John Manguja, came out a few days back and said that the central bank is working on certain mechanisms that will make it even more comfortable for banks to lend USD denominated loans from about 1.7 billion that's lying idle in FCA accounts. What, for you, in your own personal view, would be an ideal situation? What would be the most comfortable situation in which that can take place, and what effect would it have on the general economy?
Okay, I think the ideal situation for banks to lend, banks need to be comfortable with the risks that are around in terms of the customers that you'll be giving these funds, and also the tenures. When you then look at the viability for that customer, you should be confident that you'll be able to get back the US dollar funds. So it's largely around the target market criteria for the banks when you then on lending those funds to those customers, because those are depositors' funds.
There's been market fears that the bank will eventually compromise the quality of its assets through aggressive lending. In the past, FCB, in the Barclays days, it pursued a more conservative lending approach, which ensured that the quality of its loan book remained high. In the half year to 30 June 2021, I think your loan loss ratio was about 0.6%. What are the key strategies that the bank is taking in lending to ensure that its loan assets remain of high quality?
Sure. You're right. Perhaps we were viewed as a conservative bank in the Barclays days. I wouldn't say at this stage our lending criteria has become reckless or in any way form like that. We still have a responsibility both to our shareholders, but also to our depositors, to make sure that we have a robust lending process and practice in place. We like to build long-term relationships with our corporate clients, so we get to know them very well. And on that basis, when you know a customer very well and you've got robust practices and understanding of each other in place, and you build a long-term relationship, you can lend within the parameters that we do, and hence you get a low loss ratio. So I don't think we've become more reckless per se, but we do have a very clear view of how we're going to expand and grow this business. But we very much like to work in close partnership with our clients and our customers, so we can both get to know each other very well and build a long-term partnership with them.
There has been high employee turnover recently at executive level, especially. While it is expected, given that the bank is going through transitions from one brand to the other and coming on board of new shareholders, when do you see the bank stabilizing in terms of key staff?
I think we have largely stabilized. Banks and businesses will always go through periods of, if you like, change and movement. You're right. As an organization, we have come through a huge amount of change in the last number of years, particularly with the transition from Barclays through to First Capital. We've lost some people. Now, some people have gone for much bigger, better jobs. Our ex-MD has gone to Old Mutual. That's a bigger, better job, and that's a compliment almost to us in terms of the quality of people that we have coming through. But we work very hard to keep people. But I'm personally of the view, right throughout the organization, that some level of turnover is actually quite healthy, because it brings in new ideas, new thoughts, new processes, etc. And it can be quite a good thing to have. We've lost some people, as you say, in the last couple of years to bigger, maybe better organizations. Better is the wrong word, but bigger organizations. And that can be regrettable, but we're lucky that we have a clear and robust talent pipeline. And if you look at the replacement of a lot of these people, they've come through from internal. So we've grown people internally, and we've brought people up through the ranks, and we've promoted those people. So we have a good talent pipeline coming through First Capital, and we should be very proud of that and very pleased with that.
In the most recent results that you released for the 6 months to June, there is a lot of mention about the digitalization efforts that First Capital is going through, right? And we know that this is a market-wide phenomenon. Banks are coming out. There's zero data banking apps. There's all these digital products that are on offer. Can you walk us through what you personally as First Capital are doing, and what sort of products that you have on offer in terms of your digital foray?
Okay, thank you. So for us, the digital space, that's where banking is going, and that's the banking of the future. And we are also working on that to introduce new products, enhance the existing products, is we continue to enhance our customer experience and make our customers achieve their extraordinary in terms of what they'll be doing. So from that perspective, for this first half, I think the number of products that we have launched WhatsApp banking, reverse billing. We have also launched InfiniPay, which is largely bulk payments for our corporate customers. So those are some of the products that we have brought in on the digital channel space for our customers to have the convenience and the options that they would choose from and transact at any particular point in time, as in when they want to.
The aspect of digitalization has a direct impact on transactional income. Can you give us like a clear breakdown on how fees and commission income fared vis-a-vis your efforts to improve digital offerings in your portfolio?
Okay, so the digital offering, the way it works from a banking perspective is that it allows you to manage your costs. Your cost to save will come down. And on the other end, you have transactions which will then shift from some of the physical channels like your branches onto the electronic platforms. So let's take, for example, RTGS transfer. We used to have a lot of those RTGS transactions happening through the branch where customers will need to walk in, they hand in their paper, and then the transfer is done. But now with all these channels, you'll find that the transactions are largely happening through the digital channels. So I would say particularly that line for transfers, whether is it CP or is it RTGSs, I can say 80% to 90% of those transactions, they are largely happening through the channels. So you then find that out of the non-funded income that we are reporting, about 395 of that is transactional income. And I would say 80% of that is coming from the electronic channels, because that's where those transactions are happening.
So it has been very lucrative.
Yeah.
I think there's a point also to add to that. In terms of just the whole COVID, you asked me about this at the beginning. You know, there's a change and change in emphasis, I should say, on how people transact. And it's for the safety of our customers and our colleagues as well. You see the footfall through branches is declining because through the transactions and the capability Titus has mentioned, we also have ATMs. So people are going to ATMs. So if you just look at a footfall through the branches and the crowding in the branches, it is much, much less than it was in prior years. So that digitization is also very important in the current environment and the COVID environment we're operating in.
Sure. Okay, so I want to take you back a bit to your Zimbabwean dollar loan book. Right? The RBZ has been slow to adjust interest rates, and it has brought to the fore aspect of risk-adjusted return, which in some instances, given inflation, has tended to be adverse. In these current financials that you released, your loan book almost doubled. Are you confident of the environment, and have these loans been profitable under the circumstances?
It's very difficult. Well, the loans have been profitable, but perhaps not as profitable as you would get as we would like because of the inflationary environment. Okay, when you're lending at, I think the rates were about 30% from the Reserve Bank, but we were lending at, it varied depending on the nature, but somewhere in the first half around 45 to 55%. It was at that level. When you look at that compared to the inflation rate, it's hard to argue it's profitable. Okay, but the market will determine what you can lend at. And that's what we're seeing at the moment. So, we have to watch the market, you have to watch your competitors, and their competitors will watch us. And you have to be able to adjust your rates and how you lend, who you lend to, etc., depending on what's happening in that market environment.
Okay. Also, there's been talk of the very good agricultural season that we're coming from. It's even raised the prospects of our GDP growth to about 7.8% by the end of the year. Do you think that the growth in your loan book has a correlation to the good agricultural season?
No, I don't think so at the moment. I think it might do in the future. I think our growth in our loan book is down to the capacity we had last year, where I don't think we were lent to our maximum capacity. So we've continued to grow some of the deposits, but we've also increased to our capacity, certainly on the local currency side. I think you will see the strength of that agriculture season come through in the second half as we start to get into the next planting season, and you'll see a lot more coming through. So I think that aspect will become to the fore perhaps later in the year.
I want to talk about your Forex income, right? It's the only line item to record a slowdown during this first half year of 2021. So this has been driven by a stabilizing Zimbabwean dollar against the US dollar. What is the envisaged strategy so that this income is stronger going forward?
Okay, so the Forex foreign currency income line, it's largely driven by two types of customers. Firstly, you have the customers who are getting funds from the auction, and then they do their payments. That's the first set of customers. Then secondly, you have customers who have their own foreign currency, and they'll be doing foreign payments either in that currency or in another currency. So depending on the drivers, so on the auction side, what you then see is that in some cases you can have a time lag in terms of the settlement of the auction. So up to the point in time where you then receive the funds, you don't execute those transactions. So you can then have a time lag delay. But as long as the auctions continue, those transactional activity, they will continue to come onto the Forex income line. By the time we reported the June numbers, June half-year numbers, I think we had a backlog of about three or 4 weeks in terms of the auctions that hadn't been settled. So they will then get subsequently settled. Customers who have their own funds, so they are largely the exporters. You also have the domestic generators. So depending on the payments that they want to do, they also generate volumes. But from us, as a bank, from a strategy point of view, is to continue to harness the relationship with the domestic foreign currency generators and also the exporters, so that we continue to have these cross-currency transactions and increase our volumes of these cross-currency transactions from these customers who are self-funded. And at the same time, depending on the capacity, we would also want to increase our transactions throughput, which are coming through the auctions.
All right. Yeah. Also, what we noticed from the financials that came out is that the bank has largely trimmed its treasury bills, and while that is in part because of government slowed down participation in the open market for these, in recent months, we've seen the government issuing more and more of treasury bills. I believe yesterday there was a treasury bond announcement. So what is the bank's line? What is the strategy in regards to treasury bills and their issuance and uptake?
Okay. So I think with regards to that, the treasury bills from our strategy, we have largely invested in treasury bills as part of our liquid assets management strategy. To then say, when I then need funding, I can go and sell the treasury bill, then I get my cash back, or I can use them as collateral. I can borrow from another bank, or I can borrow from the central bank. Before the treasury bills, I think we had gotten used to savings bonds. So most of our liquid assets, they were actually piled up in the savings bonds. But when the Reserve Bank reviewed the product and then they ceased it, we had to move back into treasury bills. So what you see is that going into the future, you are going to see a significant growth in our treasury bill portfolio into the second half, because that's where we are now investing our liquid assets. And from a return point of view, it's also good for the bank and for our shareholders. Savings bonds, we're getting around 7%. But with the treasury bills, we are looking at yields which are around 19-20%. So that's also good for our income statement, the return that we're going to be getting from the treasury bills.
I want to talk about the capital position, the bank's capital position. I'm sure it came in about 36 million, above a threshold of a required threshold of about 30 million.
Yes.
Yes, and you say that in your financials, you say that particularly because of inflation, there is need for a cushion in a way in that regard.
Yeah.
So what is the bank pursuing, and does it have a clear figure that is targeting when it comes to your capital position?
Okay, thank you. So from a capital perspective, we continue to watch the dynamics on the exchange rate, given that some of the capital within the 36 million, some of it is in local currency. So if the exchange rate is to move today from 85 to about 90 or 100, you then see a dilution on that RTGS capital. That's why we then say we need a buffer. So in our targets, we are working with a buffer which is around 20% at any point in time of the required above the threshold. So as we stress our capital into the future with a future anticipated exchange rates, we then see the level of buffer that we are anticipating, but we are largely working with the 20% buffer in USD terms. Yeah, and from a growth point of view, since we have achieved the 30 million at half year, what we are looking into the second half is to say the income that we are earning is going to continue adding onto the core capital. And then that will be creating an additional buffer so that if exchange rates are to move maybe significantly or to a certain extent, we'll still be cushioned and we'll still be having a buffer.
So Karen, we know that First Capital is a very strong regional presence. How are you as the Zimbabwean extension of it leveraging on your regional presence?
Yeah, I mean, you're right. We are very focused on this sub-Saharan Africa, if you like, across 5 countries. And we work together closely as a group. So where we've got customers and clients who we know are regionally focused, we will ensure and try and help that they make use of the bank's network right across the countries. And there are a number of clients and customers that we have who do bank with us in multiple jurisdictions. And that creates all sorts of efficiencies for them, principally as customers, but obviously creates some business opportunities for us as well. And some synergies and efficiencies for those customers, because if they're known in one jurisdiction, it's easier to get a reference and a credit check, if you like, across multiple jurisdictions. So it's very important that we as a group work together, and particularly as we are focused, as you say, in this area of Africa.
Okay, so going forward, what's your outlook in regards of operations, regards of digitalization efforts in anything that has to do with First Capital Bank? Where do you see yourself going for the rest of the year, maybe in 3 or 5 years?
We're optimistic for the rest of the year. As Titus mentioned, clearly we're very pleased that we've reached the minimum capital buffer in the region, and we are declaring a dividend for the first time in many years, albeit a smallish dividend at this stage. But we always said to our shareholders that we had to reach the minimum buffer before we could start declaring dividends. Happy to say that we've done that. We are declaring our first dividend in many, many years, and that's a very pleasing aspect. But we have to, as Titus referred to, make sure that we maintain a capital buffer, particularly when you set a capital target in US dollars, which is essentially subject to movement on exchange rate. So you have to make sure you keep an appropriate buffer. So we are, that's a big step forward for us, and we're very optimistic about that.
Thank you so much, gentlemen, for joining us on the Equity Axis Earnings Review. It's been a pleasure talking to you, and we wish to talk some more in the near future. Thank you so much.
Thank you so much.
Equity Live presents the complete online interactive presentation solution. Hosting AGMs, media and analyst briefings has never been this simple, efficient and affordable. Communicate globally through a combination of high-definition video and your prepared multimedia presentation from any location of your choice. Interact with your invited participants from all over the world in question and answer sessions and voting sessions in real time on our safe, secure and affordable platform. Contact Equity Live for a free customized demonstration. Equity Live, real-time presentation solutions.
And there you have it. Be sure to subscribe to our YouTube channel, like and follow us on Facebook and Twitter at EquityAxis, as well as read our informative website at www.equityaxis.net for unrivaled financial insights. Good night.